What's up everyone, welcome to Stockton. It's a pleasure to meet all of you. On this channel, we talk about stocks before they start blowing up, say goodbye to chasing stocks at all-time highs, and say hello to making some money. So if this sounds like something you want to take advantage of, then hit that beautiful subscribe button and like the video. Now let's get to it. Before we get into the video, I have to say that I'm not a financial advisor. Anything I say is just my opinion and is for entertainment purposes only. Having said that, if I'm talking about a company, I'll let you know whether I'm personally going to invest in it or not towards the end of the video. But you should always do your own due diligence, so with that out of the way, let's get started.
Today, I think I've come across a company that not only has massive potential, but also has little downside. Now, as always, please remember to do your own due diligence. My job is to simply provide you with as much information as I can so that you're able to make an informed decision. When I say this company has a little downside to it, it's because we're talking about a Spac, a special purpose acquisition company. If a Spac fails to find a company to merge with, or if a merger falls through for any reason, the maximum price the share price can fall to is $10. As you can see, this company currently trades at around $11, so this means the downside potential is only $1. So personally, I like this kind of a risk to reward ratio. So the Spac we're talking about today is PCPL. This is merging with E2open. E2open is a supply chain management software. They essentially provide end-to-end supply chain logistics solutions to business with complex supply chains. According to them, they're revolutionizing supply chain management software to create real-time visibility that puts more power in clients' hands. In my opinion, you can tell a lot about a company that claims to have a revolutionary product or software by looking at its clients, and boy do they have some premium grade customers here. You've probably heard of nearly every company on this list. It ranges from Google, AMD, Facebook, IBM, Abbott, DHL, Boeing, Honda. I mean, the list goes on. This really is an impressive list of customers. They get 1.5 million average subscription revenue from their top 100 customers. They have 1,000 customers in total, with the top 125 customers providing a combined total revenue of $10 billion. So this in itself makes you stop and think about the software they must have and its effectiveness in handling complex supply chains. Which leads me into the next slide here that talks about just that. So according to them, customers that are in the consumer packaged goods sector can reduce their forecast error by 40% by using their software. These companies can also reduce their inventory by 35%, which is great because this in turn will help them cut costs. One thing that's important to highlight here is that they're using machine learning and AI in their software, which means that the software is learning all the time and it keeps on improving. They're also saying that a leading tech company was able to save $300 million in 3 years using their software, and almost all of this was related to having more inventory than they needed to have prior to using the software. So this is how effective the software is, that it saved this company $300 million. The last thing that I like to mention here is that their software is also suited to high growth companies that are in the early stages of expansion. The software helps them reduce execution time to 7 days from 8 weeks. And this in turn helps these high growth companies to reduce the staff they need to manage their supply chain logistics, which in turn means that they cut down on costs further, which is really great. Next, have a look at this graph here. They're basically showing how sticky their subscription business is. Just look at the average customer tenure for their top 100 customers, 14 years, which is really good. It's also good to see that they have a diverse portfolio of customers in terms of industries. Now I'd like to show this slide, which I found really interesting. They have the ability to double revenue without new logos, new products, or M&A. This, in my opinion, if true, is a big deal because you're essentially doubling your net income without spending on new products or marketing. The next point here is also of great significance. They're saying that there is $1 billion plus white space opportunity within existing customers. This leads us to the next slide here, which breaks this down further. Basically what they're saying is that since they've acquired a lot of customers that are currently only using one SKU, this represents a significant cross-selling opportunity. So if you look at this pie chart, 51% of their customers are only using one product or SKU, whereas the rest are using 2 or 3. This means these newly acquired customers, which make up 51% of that pie, represents a great source of additional revenue that they haven't tapped into yet. They've also broken down the 1 billion white space opportunity here into separate industries. Now let's take a look at their financials. So this looks pretty good to me. Despite the continued impact of COVID-19 on the business environment, E2open demonstrated the resiliency of its business model, growth, and momentum in Q3. Subscription organic revenue year-over-year growth of approximately 5%, advanced stage pipeline 1 year-over-year growth of 39%, PF adjusted EBITDA margin improvement of 14% to 34% year-to-date. Q3 included several new logo wins and continued execution of substantial cross-selling and upselling opportunity within existing customers, which is really great. This shows that they're able to effectively cross-sell, so that 51% opportunity that I talked about earlier is very much likely to happen in the future. As you can see here, they've also demonstrated a history of consistent organic growth. They're confident on their guidance as well. They're expecting an increase in subscription revenue and adjusted gross profit. So let's take a look at how this company compares with some of its rivals. Over here, if we compare E2open with Descartes, we can see that on an operational level, both of these companies are very similar. But when you look at the chart of Descartes, we can see that it trades 6 times higher than PCPL. So it looks like PCPL presents a very good entry point at this point in time. I think it won't take long before the masses start flocking to this company. Personally, the risk to reward ratio on this company seems very attractive to me, which is why I've started a position in this company. There are 2 other stocks that I really like, which I talked about in the Stockton Discord chat. If you want to support the channel and be a part of the discussion, then consider becoming a Patreon. Links in the description below. Well, that's it for today, guys. I hope you enjoyed the video. If you did, then consider subscribing to the channel and hit that like button. It really helps with the YouTube algorithm. Have an awesome day, and I'll see you in the next one.